Okay. Well, I'm pleased to be joined by Tony Weick, leader of Bell Bank's mortgage division. Tony, thanks for joining us today. Really appreciate it. How have you been?
Doing well. It's about 15 below here where I'm at today right now, so trying to stay warm.
Yeah, you and everybody else. Glad the home office looks kind of good today. So um anyway, so Tony, wonder if you could just briefly introduce yourself and talk a little bit about how long you've been involved in the mortgage industry and your role with Bell Bank.
Yeah, certainly. I'm the president and I oversee the mortgage division within Bell Bank. And Bell Bank is headquartered out of Fargo, North Dakota. We're about a $10 billion asset size organization, and with retail banking locations around our home office and in that general area, Minneapolis, St. Paul, Duluth, Minnesota, and the Phoenix metro. With our mortgage division, we are spread across a larger swath of the country, including central United States into the Southeast as well. So been with the entity for over 10 years, been in mortgage industry 25 plus years. So once you're in this business, typically you never get out. So lifelong, like a lot of other people around me.
Well, good for you. And I know that in your role, you keep a close eye on the economy, interest rates, housing inventory, all those things. So just kind of considering where we are now, almost 2 years into the pandemic, lots of talk in the news, of course, about inflation and things like that. But I think overall, the economy is looking pretty good in terms of jobs and things of that nature. But where would you say, what is your assessment of where we stand right now in the local mortgage industry, given that backdrop? Are you optimistic as we head into the new year?
Yeah, well, we're definitely in the midst of change, and after an extended period of time here for the last year and a half of being at record lows or setting record lows or being near record lows, and of course the influx of volume that occurred with the heavy refinance push, as well as the purchase markets were extremely strong, especially in 2021 as well. Over the last 90 days, or even you could make the argument over the last 45 days, since the beginning of the year, there's been a dramatic shift in interest rate, which has really been not completely unexpected, but of course, when this happens, it's always a bit of a shocker, and it always happens faster than I think people anticipate. The central bank, the Fed, has made obviously a definitely change in direction, and has communicated that to the marketplaces, not only to pull back on the amount of buying they're due in the MBS market and in the general treasury market, but the comments related to shrinking the balance sheet, I think caught some people by surprise. And as I talk to our capital markets and our investment group, that's probably the piece that has spurred on this pretty significant activity in the last recent few weeks here, driving interest rates to where they are. In terms of heading into this year, for the various groups that we look at and converse with and trying to judge what to expect moving forward, we do have a sense of optimism, especially related to the purchase market. We all knew that refinance activity would be slowing eventually, and of course, as you look at the MBS expectations, or the MBA expectations, I should say, and other prognosticators out there, it's going to be a very dramatic change in activity and volume as those refinances dry up. For us, we've always been a little bit more focused on purchase activity, generally run about 20% higher than the national averages with our purchase to refi percentages, and that has shown through over the last couple of years. And so as we look at heading into a purchase environment, we see that as an opportunity for us, coupled with some expansion opportunities we're looking at. It's tough to remember when we all have interest rates in the 2% range in our heads, that forecasting out even through the entire calendar year of 2022, we're still talking more than likely high 3-4%, low 4% range, even by the end of the year. Traditionally speaking, that's a really strong interest rate and drives great affordability, but it is a significant change of where we're at. We believe that every time you start to go through these upward trending cycles, every quarter in rate, every half in rate will cause a bit of a pause and allow the industry, the marketplace, the consumers to catch their breath a little bit, to say, hey, to remind themselves that 3.75 or 3.5 or 4% is not that bad, and also the new norm, so to speak, before ramping back up. So that's kind of our outlook on it. We, like the rest of the industry, are expecting a pullback across the board, but at the same point, we think it's going to turn into a really strong market based on the purchase activity that the industry will continue to see.
Yeah, you mentioned those interest rates, and I think we've been spoiled with 2%, 3%, whatever. If you think back to, I'm old enough to remember the late 70s and double-digit mortgage rates and things like that. So by historical standards, it's still pretty good when you're even talking 4%, right?
No, without question. And I think the markets will adjust appropriately, especially the purchase markets. People need to buy homes. There's that even going pre-COVID, the industry was struggling with affordability to a certain level, as well as inventory constraints in many markets, especially in the more affordable levels of the marketplace. So that was only exacerbated in all of those aspects over the last year and a half. That's a one silver lining that likely or that may occur here, is that this feverish pace of activity that's been taking place with the stories of 20, 30, 40 offers made on a single listing within 48 hours in many markets across the country, and we've seen a slowdown or a more balancing of that already start to occur. But usually, to catch up on inventory levels, historically speaking anyway, it takes a long time. You not only have to meet the demand of the current pace, but you have to over meet that demand, of course. And it's believed that the purchase pace will continue to be pretty strong. But there's some positive signs that might be starting to get more into balance compared to where we've been over the last 2 years.
Yeah, well, talking about inventory, I think it's no secret that we could use more new construction. New construction is surprisingly strong in the past couple of years, actually, based on my reading of the market. Do you have any sense of where we're going in terms of construction of new homes in the coming year?
Yeah, we quite honestly, we think it's going to be very strong. And one level, with the cost of supplies, the lack of labor continue to be major struggles in that environment. We do a lot of construction lending as a bank, as well as a mortgage entity. So we talk with our builders a lot and get a vibe and watch the national sentiment aspects as well. And there seems to be the builders are figuring out ways to still be able to provide a quality home, and in certain aspects, even from a national standpoint, or even we've seen with smaller builders too, focusing on more affordability because they see the opportunities too. There is this constant lack of supply, and depending on who you listen to and what articles you read, some people believe this is a decade long where we have not had enough new construction taking place, and it's all ramped up into the significant supply and demand issue we're dealing with. So, we do believe that new construction will continue to be very strong. I don't think it's going to go gangbusters because of the supply chain issues, as well as the cost of materials, and most importantly, the lack of labor. That's as I have conversations with different relationships across the industry, that one is the biggest piece that is really limiting the production levels of a lot of our builder partners. But I think even with all that considered, we'll continue to see strong growth there across the country.
Yeah, and affordability is another theme I keep hearing over and over again from the builders. It's really tough to build that affordable new home. And any thoughts on that from where you stand?
Without question, and you can make the argument it's on every home. When you look at high teens, or in certain markets 30% year-over-year price increases, when you talk about Austin, Texas, or Phoenix, Arizona, but at a national level to be nearly 20%, and a year ago, it was still very strong. It was 10% on a national level, or darn near 2 years ago too. So we've seen rapid increase across the board, and new construction even being more. The opportunity has been there for a lot of the new construction industry to meet the market demand at these higher price ranges too. So I think that plays into it. And as that market may tighten up a little bit as rates start to increase, and a little bit a softer environment up that when you start to get closer to that 7-figure type of new home construction, there's a belief that will drive some of the new construction players, some of the builders, back into a little bit down the steps a little bit in terms of the cost ranges, because it'll be better opportunity as rates start to increase. It'll be tough for them to juggle the cost of lumber, the cost of materials in general, the cost of labor, and where they're at. But a very resilient group that's been through a lot of ups and downs, so I think the industry will figure it out to try and meet the demand. The other piece that comes in is multifamily, of course, apartments and condos of that nature. That we've started to see in some of our markets a little bit of a pickup in activity in those areas again too. With where the world is at, and the comfortability with COVID and the pandemic, of course, really put a lot of those multifamily projects completely on hold, if not completely stopped 2 years ago. As the world starts to move forward and get a little bit more back to normal, the attractiveness because of the affordability of those multifamily units seems to be getting a little bit more comfortable compared to where it was a year ago too, and that will help dramatically with affordability issues that we're all trying to overcome.
Mm-hmm. Well, what do you think is the biggest thing that's keeping people awake at night in the mortgage industry? You mentioned the pandemic, and just when it seems like we're getting over the hump, here comes another variant or whatever, and it seems like there's still a ways to go there before we get back to some semblance of normality. What are your thoughts on that? What are the biggest, barriers? That the biggest issues that keep you awake at night?
It's the next couple years. I think everybody looks at and expects to see an extremely competitive environment as organizations ramped up over the past few years, and now it's a shrinking pie. And this is not the first time anyone that's been in this industry for a few years has seen this. So it traditionally becomes a knife fight for a while here, both in credit availability, interest rate, margins, cost controls. All of those things come into play, and every organization will make the best moves that they see for themselves to continue to provide a great place to work, great services to their clients and all the tools and products that their sales staff and operation needs. It will be a challenge though. You know, there's without question, there is a oversupply in of capacity in the industry that exists today, and it is expected to only probably get worse over the next handful of months, and companies will adjust and either try to grow in different ways or will try to shrink in different ways, and each company will have to make their own decision of that. The cost to produce everything continues to increase, cost more. Inflation is everywhere, of course, and that is not the mortgage industry and the mortgage production world is not immune to that either. And so it's been a trend that's been happening for many, many years, and we'll continue to see it be an issue that everyone has to deal with moving forward. So, and then the last thing is just technology and the evolving consumer, how they use technology, their comfortability with operating in a face-to-face environment from not only your consumers, but your referral relationships. That's yet to be seen on where that will all balance out. Historically, we've been a very, you know, a belly-to-belly relationship type company to a certain aspect, even using technology in a variety of ways, but still building relationships and rapport. It's not impossible to do that, of course, without physical interaction in terms of meeting people. But it's a different way of mode of operation than I think a lot of people in this industry have been able to deal with or work with in the past. Now, we were put to the test on that. Everyone was over the last 18 months, of course, to an extreme. You know, and it's figuring out new ways to really drive that relationship with your consumer, with your referral relationships, with your builder partners, in a variety of ways. We feel really optimistic of being able to do that in a variety of different ways, and each company will have to try and work through that on their own too.
Absolutely. Well, some great insights there, Tony. Any other parting thoughts before I let you go? You've been generous with your time and don't want to keep you too long, but any thing you want to leave with us before we let you go today?
No, I appreciate the time and the opportunity to talk with you. And you know, this industry is a resilient one, and as you mentioned, interest rates in the double digits years ago. So it can be daunting to look at a rising interest rate environment, the impacts that will have on your employees and your staff and the communities around you. But honestly, I think especially in the next couple of years, even though we might be dealing with a slight increase in rates, I think the purchase environment the market will figure it out and get to a comfortability, and we'll still be in a very, very strong environment and an attractive interest rate environment for an extended period of time here. So we feel good about where things are today and where things are going. And at the end of the day, you know, the pandemic and getting past these issues across the country continue to be a huge deal that we all just have to be smart and make sure we're making the right decisions for all of our staff and our consumers. So I appreciate the time, and yeah, wishing you a great day.
Great. And you as well. And we'll see what happens in the coming year. It'll be interesting, but
Always is.
thanks again for your time, Tony. Take care.
Take care.